Imagine someone in their 20s giving up a $5,000 holiday, driving an unreliable car for years, and turning down career opportunities all because they were told every spare pound should go into investments. What if that advice wasn't completely wrong, but wasn't completely right either? I'm Tom, and welcome to Wealth Tom. Today, we're separating financial myths from financial reality. We'll look at 4 of the most common beliefs in personal finance, explore why so many people believe them, and most importantly, examine what the evidence actually tells us. Because good financial decisions aren't built on catchy slogans. They're built on understanding how money really works. Let's start with one of the oldest and most widely repeated pieces of financial advice. Myth number 1. Save as much as possible when you're young because of compound growth. At first glance, this sounds impossible to argue against. The earlier you invest, the more time your money has to compound. And that's absolutely true. If 2 people invest the same amount of money and earn the same return, the person who starts earlier will usually end up with more wealth. So why would anyone question that advice? Because compound growth is only one part of the equation. Let's meet John. John has just started his career. He's earning the lowest salary he's likely to make for many years. Like most people early in their working lives, he's paying rent, building his career, and trying to establish some financial stability. Then he hears the familiar advice: save every spare pound you possibly can. So John starts cutting everything he can. He skips holidays. He delays replacing an unreliable car. He turns down opportunities to learn new skills. He avoids experiences that could improve his quality of life. On paper, he's doing exactly what personal finance books often recommend. But is he actually making the best long-term decision? Picture John's financial life as a timeline. On one end are his 20s. In the middle are his peak earning years. At the other end is retirement. Now imagine his income over time. It starts relatively low. As his career develops, it gradually rises before eventually leveling off. Now think about what each extra pound means at different stages of life. When John is in his 20s, an extra few thousand pounds can completely change his lifestyle. It could mean living in a safer neighborhood, buying healthier food, taking professional courses that increase his future earning potential, driving a dependable car, or creating experiences he'll remember for the rest of his life. Fast forward 20 years. John's income is much higher. That same amount of money still has value, but it doesn't transform his daily life in quite the same way. Economists have studied this idea for decades. One of the best-known explanations is called the life cycle hypothesis, but you don't need to remember the name. The basic idea is simple. Instead of trying to save the maximum amount at every age, the goal is to maintain a reasonably consistent standard of living throughout your life. Now think about what that means for John. Every holiday he skipped, every skill he never learned, every experience he passed up. Those weren't just expenses. They were opportunities that may have improved both his life today and his future earning potential. That's why saving everything you possibly can isn't always the same as saving wisely. Now, none of this means young people shouldn't save. Saving consistently is still one of the most powerful financial habits you can build. The difference is understanding that your saving strategy should evolve as your income grows. As your earnings increase, your ability to save usually increases too. That creates a plan that's far more sustainable than forcing yourself into extreme sacrifices during the years when every pound matters most. Here's the real takeaway. Your 20s shouldn't become a decade you're simply trying to survive so your 60s can be comfortable. A smarter approach is to save consistently while allowing your savings to grow alongside your income. Now let's move on to myth number 2. A fast-growing economy should produce great stock market returns. It sounds perfectly logical. If businesses are selling more, hiring more people, and making more money, surely investors should make more money too. That's exactly how John sees it. Every morning he checks the financial news before work. One day he reads about a country with record economic growth. The next day it's a booming industry that's supposedly going to transform the future. Every headline seems to point to the same conclusion. This must be a great investment. It's an easy assumption to make. After all, if the economy is growing, shouldn't the stock market grow with it? We'll answer that next. Now let's answer that question. The idea that a fast-growing economy automatically produces great stock market returns sounds perfectly reasonable. If businesses are expanding, hiring more workers, selling more products, and generating higher profits, surely investors should benefit too. That's exactly how John sees it. Every morning before work, he spends a few minutes reading financial news. One headline says artificial intelligence is expected to reshape the global economy. Another talks about a country experiencing record economic growth. A third predicts that an entire industry is entering a golden age. After reading stories like these day after day, John reaches a conclusion that feels obvious. If the economy is booming, investing there must be a smart move. And honestly, most people would agree. But here's the problem. The stock market is not the economy. That's one of the most important lessons every investor eventually learns. Think about it this way. The economy measures what's happening right now. The stock market tries to estimate what will happen in the future. Those are two very different things. Imagine a company that's expected to double its profits over the next 5 years. By the time you hear that prediction on the evening news, professional investors have already analyzed it. Large investment firms have already adjusted their forecasts. Millions of investors around the world have already started buying the stock. As demand increases, the share price rises. In other words, much of that expected growth has already been built into today's price. That's why buying companies or countries with the strongest economic growth doesn't automatically produce the best investment returns. History has repeatedly shown something surprising. Some of the world's fastest-growing economies have delivered fairly average stock market returns. Meanwhile, some slower-growing economies have rewarded investors exceptionally well. At first, that seems impossible. How can slower economic growth sometimes produce better investment returns? Because markets don't reward growth alone. They reward growth that exceeds expectations. Think of two students taking the same exam. One is expected to score 98%. The other is expected to score 70%. If the first student scores 98%, nobody is surprised. But if the second student scores 90%, everyone notices. The surprise creates the bigger reaction. The stock market works in much the same way. Prices already reflect what investors expect to happen. When reality turns out exactly as expected, prices may barely move. When reality is much better or much worse than expected, prices adjust. That's why chasing headlines can become such an expensive habit. When economic news looks fantastic, many investors rush to buy. When the headlines turn negative, many panic and sell. But by then, professional investors have often acted long before those headlines reached the general public. That doesn't mean economic news has no value. Understanding the economy is still important. It helps explain the environment businesses are operating in. But it doesn't automatically tell you which investments will perform best. Here's the real takeaway. A strong economy doesn't guarantee strong stock market returns. And weak economic news doesn't automatically mean poor future returns. Successful investors don't simply ask, which economy is growing the fastest? They ask, what expectations are already reflected in today's prices? That one question can completely change how you think about investing. Now let's move on to myth number 3. Millions of investors believe dividends create extra wealth. It's one of the most widely repeated ideas in investing. But once you understand what actually happens when a company pays a dividend, You may never look at dividend investing the same way again. This is one of the oldest and most widely believed ideas in investing. You'll often hear people say, "I only buy dividend stocks because they pay me while I hold them." Or, "Dividends are where the real money is made." At first, that sounds like excellent advice. After all, receiving regular cash payments simply for owning a stock feels like earning extra income. John thought exactly the same thing. As he continued learning about investing, he noticed that many investors focused almost entirely on dividend-paying companies. Some claimed dividends were responsible for a large share of the stock market's long-term returns. Others argued that companies paying dividends were always better investments than those that didn't. The more John listened, the more convinced he became. Why wouldn't he want investments that paid him cash every few months? But here's what's often misunderstood. When a company pays a dividend, it doesn't create new wealth. It simply distributes part of the company's existing value to its shareholders. Imagine you own a business worth 100. The company decides to pay you a 5 dividend. Where does that 5 come from? It comes from the company's own assets. After making the payment, the business is now worth about 95 instead of 100. You now own a company worth approximately 95 plus 5 in cash. Your total wealth is still roughly 100. Nothing magical happened. The form of your wealth simply changed. Think of it like transferring money from your savings account into your current account. Your money hasn't grown. It's just sitting in a different place. The same idea applies to dividends. That's why experienced investors often focus on something called total return. Don't worry about remembering the term. The idea is straightforward. Your total return includes every source of growth from your investment, changes in the share price, plus any dividends you receive along the way. Looking at dividends alone only tells part of the story. What ultimately matters is how much your investment grows overall. That's why two companies can produce very similar returns even if one pays generous dividends, while the other pays none at all. One company may return cash directly to shareholders. Another may reinvest its profits into expanding the business. Others may buy back their own shares. They're simply different ways of returning value to investors. None of those methods automatically creates more wealth than the others. What matters is whether management allocates the company's money wisely. Here's the real takeaway. Dividends aren't free money. They're simply one component of your overall investment return. Focusing only on dividend payments can distract you from what truly matters: the long-term value created by the business itself. Now let's move on to myth number 4. Many people believe index funds only deliver average returns. But the evidence tells a surprisingly different story. In fact, for most investors, average has historically beaten the vast majority of professionals. Think about that for a moment. How can simply owning the market outperform people whose full-time job is trying to beat it? The answer may completely change how you think about investing. Myth number 4. Index funds only give average returns. The phrase itself sounds disappointing. Who wants average? Most people naturally want above-average results. That's why advertisements often promise expert stock selection, professional research, or exclusive investment strategies designed to outperform the market. John started thinking the same way. If professional fund managers spend every day analyzing companies, meeting executives, and studying financial reports, surely they should consistently beat a simple index fund. After all, that's exactly what investors are paying them to do. But investing isn't quite that simple. An index fund doesn't try to predict tomorrow's winners. It simply owns a broad collection of companies across the market. Instead of betting on a handful of stocks, it benefits from the long-term growth of the market as a whole. That approach may sound boring, but history has shown that boring can be remarkably effective. Over long periods, many actively managed funds have struggled to outperform comparable index funds after accounting for fees. Even when some managers outperform for a few years, very few continue doing so consistently over the long run. That's because beating the market once is difficult. Beating it decade after decade is even harder. Every extra fee, every unsuccessful stock selection, and every mistimed investment decision makes that challenge even greater. Here's the real takeaway. Index funds don't simply deliver average results. For many investors, they've historically delivered better long-term outcomes than most actively managed alternatives. And that leads directly to another popular investing myth. Many investors believe expensive markets automatically mean it's time to stop investing. But history suggests the answer isn't nearly that simple. Before we wrap up, let's take a step back. Today, we've challenged 4 financial myths that millions of people accept as fact. We learned that saving more isn't always the same as saving smarter. A growing economy doesn't automatically mean better investment returns. Dividends don't create extra wealth. And index funds have historically outperformed most actively managed funds over the long run. The common thread is simple. Good financial decisions aren't based on popular sayings. They're based on evidence, context, and long-term thinking. The next time you hear a financial rule repeated over and over again, don't just ask whether it sounds right. Ask whether the evidence supports it. That simple habit can help you make better financial decisions for years to come. I'm Tom, and thank you for spending your time with me here on Wealth Tom. If you found this video helpful, consider subscribing for more evidence-based insights on investing, retirement planning, and building long-term wealth. Until next time, take care, keep learning, and thanks for watching Wealth Tom.